problem is that the world is likely to be much more volatile in future, and the world is in a much more threatening state than it was from 1990 onwards until we got COVID and Mr. Putin deciding to take some very rash and unfortunate steps.
Our next guest is Charles Goodhart, a British economist who worked at the Bank of England as a monetary advisor for 17 years, becoming chief advisor in 1980. From late 1997 until 2000, he was a member of the Bank of England's Monetary Policy Committee. He advised the Reserve Bank of New Zealand and supported their decision to introduce an inflation target, the first central bank in the world to do so. He is well known for Goodhart's law, which can be stated as when a measure becomes a target, it ceases to become a good measure. The theory has direct implications for monetary policy and business strategy, both of which we'll be discussing today. In 1986, Professor Goodhart co-founded, along with Mervyn King, the Financial Markets Group at London School of Economics, at which he is currently serving as the emeritus professor. He is also the author of more than 500 articles and books, including his latest title, The Great Demographic Reversal, Aging Societies, Waning Inequality, and an Inflation Revival. And we'll be discussing some of the themes from his book, as well as the implications on financial markets. Professor Goodhart, an absolute honor to host you today. Welcome to the show.
Glad to be with you.
Let's start by talking about what you told me offline, which is that you believe that the future of equity markets returns will be lower than what we've experienced the prior decades. I'd like to get your thoughts on the markets first, and then global economic growth, and then we'll talk about what you're also most famous for, which is the Goodhart Law.
Thank you. One of the reasons why growth is going to be slower is that the working forces are going to grow a lot slower in the future than they have in the past. And that will be particularly so if the very large recent increases in immigration slow down. If the working population is growing much slower, overall growth is going to slow down at the same time unless productivity per head increases a lot. And there is no sign of that happening at the moment. Though I would note that Japan, which has been aging faster than any other country, has done better in terms of productivity per head than almost anywhere else. But even so, the aggregate growth rate of Japan is now quite slow. So this is simply a function of demography.
Do you think then productivity will pick up to fill that gap in lower population growth?
It's always possible, but there are no signs of it at the moment. Nobody knows how much the advances of artificial intelligence and various kinds of skilled robots how much difference that will make to the growth of productivity. But I think we've got to be a very considerable optimist to believe that productivity will rise sharply from now on, particularly, again, since a significant proportion of the workforce will be involved in looking after the aged people, like myself. So many of us are incapacitated, and that's not a particularly productive form of work, though necessary and socially useful though it is.
Do you think globalization is near its end, Professor?
One of the reasons why I think that productivity has been slowing down recently has been that globalization has reversed very sharply. There are barriers going up between the United States and China. The world is divided into blocks, an autocratic bloc and a democratic bloc, and a sort of a middle of the road, unaligned bloc in between. And that has held back the growth of overall output, and the switch of policy away from free trade towards protecting one's own workforce is understandable, but it is not likely to lead to the kind of rates of productivity that we enjoyed during the wonderful 3 years from 1990 to 2020, when such a large proportion of the world's population got taken out of poverty.
Now, in your book, you've discussed how a lot of the forces that have held back inflation may be reviving inflation going forward. Can you expand on this?
Yeah, well, we've already touched on them in a sense. The workforce is slowing in the advanced economies,
Okay.
those subject to the inflow of immigration. The world is dividing into blocks. There is a shift away from free trade to where it is most efficiently done, to protection. The needs of expenditure for climate change, uh, for defense, for looking after the world's aging population, are all going to take up scarce resources. That means that if we're going to have a sustainable fiscal policy, taxation has got to increase. And all these factors mean that the supply side is going to be very, very much more difficult, and that the world is going to see a general increase in the underlying inflationary pressures. The decades from 1990 to 2020 were unique in many ways. They were remarkable, they were wonderful decades, but they've come to an end. And we're going back to a world which is going to be much more normal, by which I mean inflation is going to rise normally, sort of 3% and above. It's going to be hard for central banks to hold it back. Interest rates, nominal interest rates will have to be higher, taxation will have to be higher, and growth will be lower. It's not a disaster. It's a major setback compared to what, if you like, the younger part of the population have been used to. But if you look at the broader sweep of history, as long as we can avoid world war and we can deal with climate change, the outlook is perfectly okay. It's just not as brilliant as it was in those decades. And all that means that equities and profitability will do considerably less well over the next 3 decades than they did over the past 3 decades.
You're assuming then, if I may interject, are you assuming that in this future of supply shocks, we would not have a global liquidity shock, meaning that there would be sufficient credit to sustain our demand, and there wouldn't be a dry up of credit and money supply, such that even though we may be in for fewer supply, our demand would not be diminished.
I think that the real problem is not monetary policy and what monetary policy can do, it's fiscal policy. As I've said, the need for public expenditures is going to remain and indeed increase.
Mhm.
Uh, Interest rates will likely go up, not enormously. That growth will be a bit slower. That's going to make it that much harder to uh, issue debt, particularly public sector debt. And there's going to be a problem. If you don't resolve the underlying fiscal problem, that will put huge pressures on the government debt market, the treasury bond market. There will be an enormous temptation for the leading politicians to try and persuade or even force the central bank to keep interest rates down and keep the treasury bond market ticking over. And that would lead to a much more rapid increase in the money stock, and that would lead to even further inflationary problems. And we could get the debt problem resolved at the expense of much greater unexpected inflation. The alternative is that if the central bank doesn't support the bond market, you could get a really severe downturn in the bond market, a really severe downturn. And if that was to occur, the downturn and the increase in long term interest rates could be sufficient to drive us into deflation. So the problem is that the world is likely to be much more volatile in future than it was during the Great Moderation. Though whether it will end up in a much more inflationary state, or even because of financial problems in a much more deflationary state, is yet to be determined. All I can say is that you better buckle your belts because the world is going to become very volatile and very uncertain, much more so than during the Great Moderation of the past decades.
Which of these alternatives do you think is more likely? Higher inflation, unexpected inflation, or deflation?
I don't know. I really don't know. And don't ask me what would trigger them either, because again, I don't know. It depends on the interaction between the politicians, what they do on the fiscal front, and the monetary authorities. And we don't know how that interaction will play out. That's for the future.
You said that the world is a lot more volatile. We're going to become a lot more volatile than the past Great Moderation period. What is it about the world that is going to be a lot more volatile? Is going to bring a lot more uncertainty, both in terms of our for our economy, but also for our way of life.
Well, it was very largely geopolitical. I remember that as sort of the end of the Berlin Wall and the entry of China into the World Trading Organization and the freeing up of Eastern Europe and all of that. And the fact that demography was enormously beneficial. With fewer children, many more married women were entering the workforce. Wages were held down by competition from Eastern Europe and China, and the availability of many more women coming into the workforce. So there was no inflationary problems really significantly at all. The debt wasn't then a serious problem. And the economies did really very well, extraordinarily well. And those 3 decades were wonderful, but they're behind us.
Yeah, but we at the same time there was a Cold War between two blocks that hindered a lot of
But
progress and whatnot.
not nearly as severe a war as there is now.
Right.
And we've got the Ukraine war, we've got problems over Taiwan, we got the Middle East, we got Sudan, and the world is in a much more threatening state than it was from 1990 onwards until we got COVID and Mr. Putin deciding to uh, take some very rash and unfortunate steps.
Do you think that the emergence of these local wars, regional wars you were talking about, is a result of the U.S. losing its global hegemon? Now, in the past, historically, whenever there was one very obvious superpower, there tends to be more peace around the world. It's only when we've had multiple countries vying for superpower status that wars emerge.
That's a political issue rather than an economic one. I'm not sure that I'm really competent to answer it. I, I understand the point, but I think I'll pass on that one.
Okay.
History will determine.
Okay. Well, turning now to the fiscal unsustainability you were alluding to earlier, you wrote in your note to me, my own concern is that the fiscal outlook in the U.S. appears to be unsustainable in the sense that the projections by the Congressional Budget Office in the U.S. show an exponential increase in the public sector debt ratio and continuously rising deficits. What is the immediate impact on financial markets should this unsustainable deficit level continue to rise?
It makes the sale of an ever increasing volume of treasury bonds to fund the deficit increasingly difficult. In addition, you have quantitative tightening with the Fed trying to sell away from the vast quantity of bonds that it holds in its balance sheets, and the use of sanctions, financial sanctions, in recent years by the United States means that quite a significant proportion of countries who might otherwise be keeping their reserves naturally in the US Treasury bond market will have second thoughts about doing that in case they might run foul of US policy at some future date. All that adds up to a potentially quite tricky future for the Treasury bond market. Now, that future was completely overshadowed or bypassed by the fact that until very recently, there was a generalized expectations that interest rates in the US, nominal interest rates, would come down quite steadily, about 1 or 2%. In the course of the next year, which meant that if you bought bonds, you expected to get a short-term capital gain. When that expectation, as it is now, is receding and may lead to an expectation that interest rates will rise, trying to sell bonds into a world in which expectations are of maybe slightly rising interest rates, together with the underlying structural problems that I've been talking about, QT and the US being less favored as a reserve center, could mean that the US bond market could be in for a significantly tricky time, sometime over the course of the next year or two.
When you say that the U.S. is less favored as a reserve center, who or what is taking its place?
Good question. And one of the answers to that may be gold. Gold prices have risen really very sharply over the last 6 months. A lot of it is retail demand, notably in China, but some of it may be wealth funds and other centers of reserve accumulation, preferring gold to UST bonds. It's also possible that a wider range of countries might find a larger inflow. For example, I was in Switzerland the other day, and if people get upset about US policies, Switzerland has always been a successful neutral country, and you could see an increasing flow of funds into the Swiss market.
Yes. On that note, on gold, what was the Bank of England's position on holding gold reserves? What was the purpose of the reserves for the Bank of England, in other words?
I think it was always a form of diversification. I remember that the correlation between the returns on gold and the returns on bonds have tended to be very low. So having a certain amount of gold in your reserves was not, even though it has a zero return, particularly when conditions are likely to be volatile, is not necessarily a bad investment. The bank was actually told to sell their gold by Gordon Brown. I think when he was the Chancellor of the Exchequer under Tony Blair. So it's got, as far as I know, it's got very little left at the moment.
Yes, yeah. There was a trend of selling gold. You're right. Um, with if you were still working for the Bank of England, were advising them, would you suggest for the bank to hold digital assets in reserves such as Bitcoin?
No, certainly not Bitcoin. Bitcoin is wildly volatile. Um, and it's not only wildly volatile, it's sort of innate, inherent purchasers, other than those who are pure speculators, are actually those who want to hold it because it is entirely anonymous. And you want to hold an anonymous investment because you're some kind of wrongdoer and trying to avoid legal issues elsewhere, money laundering, etc., etc. So I have a sort of a fairly clear preference to avoid Bitcoin whenever possible.
Okay. Is that if it were to become less volatile over time, meaning if it were to mature as a financial asset, would that change your mind?
Uh, it's possible, but I doubt if my mind is likely to be changed on this in the relatively few years that the good Lord is likely to give me from now on.
Wow, you look like you're in great health, but I understand your point. It would take some time for this asset to mature to that state. All right, I'd like to move on to a topic that I think may be of interest to a lot of our viewers, which is Goodhart's law, which can be summarized as when a measure becomes a target, it ceases to be a good measure. Can you just elaborate on that a little bit more and sort of the foundation of your study here that led to that thesis?
Well, it was actually a throwaway remark in a presentation that I gave in Sydney, Australia, in sort of, I think it was about 1976. That was a time when monetarism was becoming a great deal more popular, indeed, even trendy. And the central banks around the world were beginning to try to control their monetary aggregates. Now, one of the problems with monetary aggregates is that there are a whole series of them. There's the monetary base, sometimes known as M0, there's narrow money, M1, there are whole quantities of different kinds of broader money, M2, M3, etc., etc., etc. So there was a choice that central banks had to make about which monetary aggregate they would choose to try to control. Now, whenever they chose a monetary aggregate, it just so happened at that time that that monetary aggregate started to misbehave in the sense that the relationship between that aggregate and nominal incomes became much more unstable. And so I sort of coined, as a sort of throwaway aside, the law that bears my name, but it does have a much wider relevance, and it did seem to catch on in a wide range of social sciences. The point is that you're trying to provide something excellent, say in education, and you want to think, well, how do we tell which school or university is best? And you look at a whole series of various facets of education, and then you usually or very frequently pick on one as being most closely related to your general view about what is best. So that let's say that schools which uh, uh, do a particular test or provide a particular kind of homework do best. And so you choose that as your target. Now, the problem there is that the moment you've chosen that as the target, everyone will switch their behavior and put all their, or a much larger proportion of their resources into achieving that one aspect of education or health or economic policy or whatever. And that will mean that they pay less attention to all the other facets that in practice and in the broad are as or much more important. And that means that even if they achieve the target, it won't necessarily mean that they achieve the excellence overall that you want, because they'll be choosing their policy simply to achieve the target that has been set, rather than to achieve overall excellence. And indeed, there's even another facet, which is that in some cases, when the target has been set by the government has an incentive to manipulate conditions so that the target appears to be met, whether or not in reality it has been met. So both the setter of the target and the recipient to the target have an incentive to adjust their behavior in a way that breaks the relationship between that measure that you've chosen and the sort of overall results and for excellence that you are trying to achieve more broadly. So the great advantage of Goodhart's law, so to speak, though I didn't think of it at the time, is that it's not specific to economics. It's a general. It is generally applicable to virtually all the social sciences and has been used in other social sciences as much or more than in economics.
Suppose, if I were to just draw an analogy, I like cars. Suppose Ferrari were to maximize revenues as a potential measure of success. In theory, according to Goodhart's law, they may make cars of lesser quality, thus diluting their brand image and thus actually making less revenue. Would that be a good analogy to make?
Not entirely, because um, if Ferrari are sensible, they're trying to maximize the present value of all future revenues, and they should appreciate that lowering the quality of their cars would damage their future revenue. Um, and this is not, Goodhart's law is not in any sense meant to be a disclaimer or an attack on longer term maximization of the present value of future profitability.
Going back to my example, in this particular case, if they were to mass produce their cars to, I guess, make more of them to make more money, well, the brand prestige would be lowered because there's all of a sudden more supply and therefore, becomes more attainable and so on, becomes less exotic, right? I'm just using that as an example.
Yeah, again, I don't think that's really applicable.
Could you provide us an application of this law for, I guess, businesses, not just governments?
Okay, let me try. Uh, let's say that you think, what is it that attracts people most to electric vehicles, electric cars? And you decide that what you want to do, because it's the thing that most people care about, is the size and scale of the battery that will enable you to drive without recharging for longer. And so you set as a target that all your cars, electric cars, will have a battery that achieves a certain mileage before recharging. Now, what you might then do is so focus on on the batteries that you ignore all the other aspects of electric cars, so that the end result overall is less good, because you've simply focused on that aspect of the car
Mm-hmm.
that you think is most important?
Tying this to monetary policy now, do you think the U.S. Federal Reserve and maybe in some ways the Bank of England has done exactly that, which is to focus their vision on too narrow an objective and missing the overall bigger picture?
No, I don't think that that would be fair, because they are concerned with the rate of growth of output and unemployment, as well as trying to bring inflation back to target within a reasonable period. I do think that they focused excessively on the demand side of the economy and have paid far too little attention to the various determinants of supply, in particular the availability of workers, what determines their participation rate, and so on.
All right. Overall, then, closing off monetary policy, just because we're talking about this, how would you evaluate the performance of the Federal Reserve right now?
I think it's actually been really rather good. I think they've been surprised. They were not only surprised when inflation rose, that was because they expected a much greater return of labor to work at the end of 2021 than turned up. They didn't realize how tight the labor market was likely to be and remain. And they, I think, overestimated the effect of the increase in interest rates that they put in place on reducing the tightness of the labor market, even though the rate of migration inward into the United States was greatly higher than I think anyone had actually expected at the time. So the supply of labor to the American market via inwards migration was much larger than expected. Had it been as we had thought it was going to be when we wrote our book in 2020, God knows what would happen in terms of the tightness of the labor market now. So they've been surprised by developments, but none of us can foresee the future, and I think that on the whole they've done pretty well. It would have been, I would have liked them to have been much more concerned about supply considerations, but the world is always changing. It's not static, and we don't know exactly how it's going to change, and we are always in a reactive mode. And I think that the Fed has reacted on the whole pretty well.
Overall, then, do you think central banks in general, not just the US Fed, but central banks, should they have a target for inflation? I mean, per Goodhart's law, would you not target inflation and perhaps sacrifice other components of the economy? For example, if they were to bring inflation back down to 2%, that risks putting the economy into a recession if they keep rates higher for too long, right?
Yes, but as I said, the target is not that extreme and that fixed. I mean, it's and indeed there wasn't an agreed target for inflation until I can't remember exactly when, but it was within the last sort of 10 years or so that
I
they
believe the
adopted.
Bank of New Zealand was the first to do it.
Yes, I was an external advisor to the Bank of New Zealand at the Reserve Bank of New Zealand at the time.
Yes.
In 1990, I could tell you all about that. And I think that I was in favor of inflation targets. You need to have, you need to make the central banks accountable. And if they're going to be accountable, you've got to have some kind of measurement. Now, you're quite right. The measurement mustn't be too narrow, otherwise you're likely to run into trouble. But the measurements have not been that narrow. It's been inflation and output and unemployment. And as I've said, in future, unless we're very lucky and the fiscal position changes dramatically for the better, we may find that there's a need for monetary policy to take much greater concern about debt management than it's been able to do in the course of the last few decades.
Uh, Several people have asked me, why is it that central banks target 2%? Why not zero? Certainly, we as ordinary citizens and consumers would like our goods and services to not go up in price every year, and perhaps our living standards would improve if that were the case.
Well, there are a whole series of reasons why it was started at two. The first one is that the price level is not and never can be completely accurately measured because it's very difficult to take account of the improvements in quality. And to take one example, the computers that you and I are now using are vastly better than they were in the past. And how do you adjust the prices for the improvements in quality? And the general assumption, which has got some academic background, is that the quality improvements are underestimated, and so that 2% as measured is probably quite nearer to zero in reality. The second issue is that if you had a target of zero, it would normally mean that it would be very difficult for some sectors and some industries to continue working efficiently and competently without having wage rates going down. And the general view is that people just hate having their wages cut. And the it would make it vastly more difficult to get right down to zero because of wage rate resistance, so that you couldn't do it without having a much higher level of unemployment than you and I and the rest of the world would actually like. So if you take account of changes in quality and wage rate resistance, 2% is probably about as close to zero as you can get. And Alan Greenspan's dictum about what you want is a inflation rate that nobody notices actually holds for two. Whether it would hold for 3 or 4%, if the conditions become more difficult as we think, is less likely.
Is there theoretically or even practically a golden policy rate such that 2% inflation could be achieved consistently without sacrificing growth?
And it depends on all these other factors. And in particular, it depends on supply side factors. It depends on geopolitics, and depends on whether we have war or not. Depends on whether we can achieve climate change. Let me just take one issue. We've had a lousy winter in the UK. Not cold, but it's rained more or less continuously. All the autumn sown crops have been drowned, and the farmers have not been able to get on the land until about sort of last week or two, 6 weeks later than is necessary for spring sown crops. The harvest is likely to be 20% worse than normal. That's mean that food prices are going to go up. Climate change, unless we manage to deal with it, is likely to have fairly adverse effects on lots of things, including agriculture. And so, I expect food prices worldwide, but particularly in the UK, to start rising significantly and worryingly in the autumn, even if everything else goes right.
Okay, so the policy rate should always be in flux to adjust for changing conditions, is what you're saying.
Yes, and conditions are going to go on changing.
Yes.
That's part of the human system. That's what we are.
Final question. I'll let you go, Professor Goodhart. When Paul Volcker was in charge of the Federal Reserve, he raised the Fed funds rate to double digits to combat double-digit inflation. Jerome Powell did not raise the Fed funds rate to 9%. However, we saw that inflation did come down from 9% to where it is today. So, in retrospect, that perhaps was not that necessary. But people have argued that the Fed funds rate should have been higher. Where do you stand on this debate? Should he have done more?
No, I don't think necessarily so, because again, a lot of the increase in inflation was due to the aftershocks of COVID combined with the impact of the Ukraine war. Much more so in Europe and the UK than in the US, because you avoided the larger proportion of the energy shock that we really had over here. But even so, a great deal uh, of the increase in inflation was a supply shock, and that supply shock was always likely to be temporary. My argument is not that they should have increased interest rates by more. It's rather they should have started increasing interest rates earlier and got it up to the present level at about 5.25%, 5%, instead of reaching the peak sort of early 2023. If they'd reached the peak, say 6 months earlier, I think we'd be in a much better state than we are now. So it's not a concern about the extent of rise; it's a concern about the speed of rise.
Professor Goodhart, thank you very much for your time today. Where can we learn about you, read more from you, read about your work?
Well, you can find my books in any decent library. And my articles are mostly in academic journals, which nowadays you can usually find if you look for them on your computer.
Okay, we'll put the links to your most recent book in the description down below, so make sure to follow Professor Goodhart there. Thank you very much. It was an honor to speak with you, and I hope to see you again soon.
Thank you, David. It's been a pleasure.
Thank you for watching. Don't forget to like and subscribe.